Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Shawn Cruz. He's a manager of trader services over at TD Ameritrade with our midday update. And you would think that you'd see some more selling in tech, but it's actually some other sectors that are taking it on the chin this afternoon. It's great to have you with me as always, Shawn. And after that 3-day weekend, you have to pay the piper and deal with all the news that you're going to get in a 4-day week instead of 5 days, that's for sure.
You do, and there was plenty of that. I think traders had a sense going into the weekend that there's a lot that can come out over the next couple of days. I don't think many were expecting the Apple profit or the revenue warning from Apple to come out, and that was what really, I think, threw markets off a little bit here in the early go. But what was interesting is I initially expected to see that heavily focused in the tech sector. And I was expecting to see the Nasdaq down, I think, a little bit more than any of the other indices. And you actually saw it, actually the opposite effect. And the reason was you saw energy down big, you saw financials down big as well. I think that was really where and industrials, I'm sorry, were also down quite a bit. And that's what caused the S&P actually to be a little bit more of a drag versus the Nasdaq, because some of the tech names were actually doing pretty well. Microsoft had a good day, Google, Facebook, Netflix.
Let's pull up our heat map here, and I love taking these. These are a quick glance, and you're able to see what the market is doing, what sectors are moving. I mean, even talking about the tech sector, the Nasdaq 100 was, I think, almost near flat before we came on, down about 0.2% right now. But if you take a look at it, like you were saying before, Microsoft, Google, the major Nasdaq 100 companies, they haven't been hit by the news.
They haven't, and if you really look where the red on the screen is concentrated, you've pretty much got all the industrials in the red, all the energy, financials in the red, some healthcare. So I think it makes sense when you're seeing these other sectors where the Nasdaq does not have a lot of exposure. That's why you're seeing the Nasdaq 100 outperform. And once again, you're seeing a lot of strength over here. Facebook, Netflix, AMD surprisingly able to buck the trend of the chip makers that were down earlier on, Microsoft, Visa, Salesforce, Adobe. So Apple and some of the other chip makers are getting dragged down as you would expect, but it's not acting as big of a drag on the tech sector in general, and that's why you're seeing a little bit of, I think, outperformance from the Nasdaq today.
All right, let's take a look at the 10-year here, because that, again, below 2%.
That is something that we haven't seen. We saw it pop here earlier a couple weeks ago, but this 2% level actually seems like a pretty significant price level going back over the past year. So I think right now markets are pricing in the potential for global growth to become a little bit more sluggish, and central banks having become more accommodative to maybe prop up some of these economies if this coronavirus doesn't get resolved soon. And so you're seeing that money flowing into the safety of the 30-year Treasury, really pushing that yield down, because that's the opposite effect you have there. The money goes in, pushes prices up, the actual yield then comes down on that. So I want to look and see if we can get a close above 2% today. Otherwise, you might see markets really start giving you the signal that they are pricing in some weakness here, at least in the near term, for the global economy.
All right, let's go back to Apple for a second here, because despite what we think fundamentally, what you think on the chart, you really have to take a look at what volatility is suggesting with the name. Is it telling you that it should be moving higher or lower? Were you surprised about what the vol reading looks like?
I was actually surprised at the volatility reading. So when you see something down the way we saw Apple down today, pretty sharp pullback earlier on, down over 2%. I was actually expecting to see, and especially given the news that they were cutting down on their revenue guidance, because they've actually done that once in the past as well recently. So I was surprised to see that implied volatility, if you look down where we're at, sort of in the middle of that range we've traded in for the past year. So we call about the 50th percentile, halfway between the top and the bottom. I was actually expecting it to see it at least in the up 75% or higher, really up there towards the top, but it doesn't look like there's very much panic or uncertainty being priced into Apple just yet. But you definitely don't want to go all in and maybe buy here, because that implied vol is still elevated, and they're letting you know that there's still some uncertainty for what may lay ahead for Apple.
All right, let's wrap it up with our following chart here. The New York Fed report. Now, this is taking a look at data from the economic perspective. Does any of this include any potential coronavirus impact yet?
I don't think it does just yet, because they actually take this reading on February 1st is when they send the survey out to about 200 CEOs and presidents from large manufacturing companies. And what they do is they ask them what they were seeing for the previous month in January. Coronavirus didn't really start hitting markets until mid to late January, so I think there may be some effect, but it's definitely becoming more pronounced in the past couple weeks as we got into February. So that's why I don't think it's entirely priced in here. There was a pretty good headline number, so I don't want to draw away from that. But if you look at what the forward-looking indicators that are in this are showing you, the expectations for the 6 months ahead, ahead. General business conditions, although still positive, are starting to come down a little bit. And then new orders, which to me is a very strong indicator of what future expectations are going to be, especially for us now. We're looking at the second half of 2020. Those also are coming down. So although they remain solidly in positive territory, it'll be interesting to look at some of these manufacturing gauges for their readings for the month of February and see, now that we've really had, I think, a little bit of an amplification of the coronavirus concern, if you see a further pullback in some of these sentiment gauges, because these are really what I like to look at to get a sense for what is the actual economy doing, what are the purchasing managers, what are the people making the capital expenditure decisions, what are they seeing? And right now they're seeing a little bit of a deceleration. You don't want to see too big of a further pullback, or you're going to start seeing expectations for just general growth in the U.S. economy throughout 2020 to come down along with it.
Yeah, you definitely need the CapEx spend to justify the multiples that we're at right now.
Yes.
Great to see you as always, Shawn. Thanks so much for joining us. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.